right, shall we start? Good evening. After every lecture where I'm just telling you about the essence of this, that business process or a certain element of business activity, I'm actually wondering whether you are capable of somehow integrating that knowledge that you have during these lectures, and then so that this knowledge becomes part and parcel of your business practices and business activities. Therefore, well, my first question is: have you ever tried to speak business to anyone and see what the reaction of these people would be when you actually start talking business to them? Does it exist ever in your life? No? All right. Then let me ask you about something that may give you a certain idea how this could be done. Well, first of all, as I said, you read the business press and you read the financial press and you try to make certain sense of that. But the most important thing is that you yourselves would be capable of actually delivering a certain knowledge that is related to business activities. Therefore, as we said, it's important, as we said already during the previous lecture and the first lecture, it's important to formulate for yourself the notion of value or the notion of usefulness. You know, there is a very interesting phenomenon that is called investor relations in business. Investor relations is such a huge activity where you would different companies are working to attract the attention of investors and make them be interested in your business, invest in your business, and become partners and sometimes closely related to what you are doing in business. And the relationship with investors is, from my point of view, one of the most difficult, one of the most complicated activities that you might be having in your future business activity, if you have any. I was trying myself several times to speak to different investors, and it's normally a very hard business because they get bored within the first 3 minutes of your talk. They don't allow you to speak 5 minutes. When you speak to investors, you should be capable of explaining your idea, your business idea, within the first 3 minutes. You know, there is one of the most popular formats for spreading your business ideas among investors is the so-called roadshow. Roadshow is the format where you go around different investors and spend about 15 minutes to talk to the top investors whom you are thinking of as potential partners of your business. And within these 15 minutes, you need to be able to tell them everything, from your business idea, from your value, to show them your financials, everything within 15 minutes. And this is just incredible. And somebody told me that when I was asking about the efficiency of communication with investors, they said that if you are not capable of formulating your business idea within 2.5 minutes, you're lost. This means that if you meet somebody, some potential investor, when going up by elevator to a different floor of the building, when during the elevator you can talk, you see a potential investor, and you say, "May I have your attention for a second?" And then you have 2 minutes to tell this investor what you have in mind, what sort of business you want to start. And if within these 2.5 minutes you fail to communicate your idea, you're lost. The investor usually quickly loses interest. May I ask you, some sort of an experiment, to do the following? Maybe this evening, maybe tomorrow, on base camp, try to formulate, to give a scenario of your quick talk to a potential investor of a certain business that you might be thinking of as your potential business. Think that you have an idea, I don't know, to start bakery, cookery, to start a canteen, to start a transportation company, to start a bank, to start an educational institution, to start anything in your life that you think might be of interest. And then try to think and formulate, first probably in Russian and then in English, what sort of message you would want to communicate to a potential investor within 2.5 minutes or within 3 minutes. Try to look for the arguments that from your point of view would be very, very convincing. And then ask yourself whether you yourself would react to what you are saying. Let us see how successful you would be. At least it doesn't matter in what language it is. First try to make it in Russian, and then you may either translate it into English or rewrite the same thing in English. It's up to you. Is the task clear? To understand what to do? Just think of any business that you think might be, or potentially, the business that belongs to you, to your father, to your brother, to your sister, anyone whom you know, and you say, think of yourself as an investor relations specialist. Investor relations specialist is a huge profession with conferences and events and organizations in this market working very hard, trying to convince the investors about the necessity to part with their money and leave it somewhere. You know, when I worked in one of the consulting companies, and I asked one of the directors of this company about her definition of the investor relation activity, she used a very rude phrase. Actually, I will try to adapt it a little bit to your audience. But she said, инвестиционная деятельность – это перекачивание денег от непрофессионалов к профессионалам. But she used different words. Okay. So when you are making your 3 minutes talk, your understanding is that you are talking to a non-professional in your business. Something that you do not actually, something that you know personally, but some sort of an idea that can wake up anybody's idea, anybody's attention and interest very, very quickly. All right. Business is, of course, is about finance, and we're going to speak about what other parameters of financial statements and the types of financial statements that are used by business that are very important to take into account when you're making the analysis of business and writing or reading for business. But there is also one thing that I thought would be quite important to take into account. You know, yesterday or last week when I was preparing for your lecture, I came across a book that I thought that attracted my attention as something that could be a possible readership for you. The Smartest Guys in the Room, The Amazing Rise and Scandalous Fall of Enron. Have you heard the name ever? Enron, no? Yes. Enron was one of the top companies in the United States of America, working in the sphere of commodities, electricity, services, and trading of securities in the stock exchange. So they were doing quite a lot of things until the moment when it suddenly and unexpectedly collapsed. This was one of the most successful companies in the United States of America at the end of the 20th century, and in the beginning of the 21st, it suddenly collapsed. At its highest point, its stock was selling at a price over $90 per share in the stock exchange, over $90. And on the next day after bankruptcy, after this scandal with Enron, its stock fell as low as $1 per share, very, very low. So what happened? And the understanding of this phenomenon, of Enron phenomenon, will give you a good idea of what sort of things should also be taken into account when thinking about business, when writing for business, when estimating business, analyzing business, and understanding how language is actually used in it. You know, it's one of the small lyrical digressions about business. You may think that all business is about some sort of activity like manufacturing, selling, services, human relations, attracting people, and so on and so forth. But in fact, not a single type of activity in business is possible without a document. At every stage, there is a paper. At every stage, either it is a letter or a presentation or a report or a website or a contract or an agreement or a draft, anything. Every stage, or a resume or CV that you are sending and then that is being analyzed. At every stage, there is a document. And this is a very interesting phenomenon. If you think about business, let's say before the 40s, before the Second World War, was there so much paper at that time as today? No. There was no standard reporting, regular reporting. People were not writing reports to each other, were not communicating through the paper. But today, business is unthinkable without that. So this is something that this is one of the things that made this company Enron collapse. So let me briefly tell you. So you see on the right side, there is a fragment from this book describing how this person, one of the leading specialists. You see, it's what is that here? See, there is a description of how Cliff Baxter, who was the vice president of the company Enron, committed suicide when he learned that all sorts of procedures are starting against Enron. So Enron is a company that led to tragedies. Many people lost their jobs, lost their revenues, lost their pensions, and it was one of the most spectacular collapses of a huge business in the whole history of the United States of America. So what happened? These people who were doing this business, they started thinking about how to increase productivity. And increasing productivity is a sort of a logical activity, largely. You think about how this could be done most efficiently. May I ask you about the possible vision of how to increase productivity, make your company very productive, profitable, generating a lot of income, generating a lot of cash? What should be done from your point of view in order to make your business very, very, very profitable? What? Cut costs, cost cutting, yes. Buying new assets, assets that can generate cash. Yes. Anything else?
Staff leverage.
Yes, staff leverage. That's true, right? What else? And you may think of a different walk of activity, right? This company was doing all this stuff, but they were, in addition to that, they started doing something very, very special, and this very special thing is changing the way to value the company, changing the way the company is valued, as the company is viewed. If you want to look nice, just think of an ordinary human being. If you want to look nice to people, what do you do in order to look nice? You try to show off your good qualities and you try to hide your poor qualities, right? Meaning, we're all lying in this sense. Whenever we speak to somebody, we try to stand straight, we try to hide our punch, right? We try to walk in a nice manner, we try to change our voice and so on and so forth. That's what we're doing. These guys thought the same. They thought that it's a good idea to hide the bad sides, the poor sides of the company's business, but hiding it to such an extent in such places where no one could find it. So they started doing two things. First of all, they started hiding the stocks that were not performing quite well in this market. Hiding, not showing to the investors that there is a certain stock that is not performing quite well. But worst of all is that they began hiding debts. Hiding debts. Showing the profits and hiding debts. That was sort of very clever. But in order to achieve such good face, good performance, good presence for the company, they started using an absolutely different type of business valuation that was called mark-to-market. Mark-to-market is a valuation of business in terms of today's interest. Today's interest. It means that if, for example, I start selling a certain item in this market, and this market, for example, the value of this market, let's say today, is $1, and if I, through the promotional activity, showing to the market how good it is, the value of this item begins to grow, I begin to write it in my reports that the value is as today because of my promotional activity. So this means that due to the mark-to-market valuation, investors and partners started thinking of this company as a highly profitable, highly innovative, highly reliable, trustworthy company. So I'm using the words that I think will be very good to remember because these are all synonyms. So in business talk, it's good that when you are capable of creating at least 5 or 6 synonyms when you are talking and describing a certain event. So when at the peak of their promotional and market activity, Fortune magazine called them one of the top leading innovative companies in the United States of America, without knowing how they actually how they dealt with debt and poorly performing stock. Let me show you a small film about that, and then I will return to the explanation how debt was actually hidden. That's quite interesting. It briefly describes to you the essence of the crash of business and will give us a better understanding of the nature of financial statements that should be taken into account when you analyze any business and have a closer look at their activity. All right.
It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets. And it took them 24 days to go bankrupt.
Just an immediate sense of outrage at Lay and Skilling and Fastow when people realized how much they had profited and how completely artificial the appearance of this company had been.
That nobody could really understand, and in fact that many of Ken Lay's lieutenants questioned. They said this business can't be making this much money legitimately. Something weird is going on.
Mark-to-market accounting allowed Enron to book potential future profits on the very day a deal was signed.
So they're saying, the previous speaker was saying that these people are making so much money and they look so valuable that it's just unfeasible, unthinkable that people can earn such a great amount of money within a day. For example, you would know that some of the top management of some of the leading companies in this country and abroad may daily earn just dozens of millions of rubles. We know that, and we read from time to time in the press that this happens. And this time we begin to ask ourselves the question, how does it happen? How can it be possible? And but when a company, for example, daily begins to generate millions and millions of dollars, you start thinking about how that is possible. You begin to be doubtful. So that was the whistleblowing thought that actually led to many people thinking that there was something wrong behind that.
No matter how little cash actually came in the door, to the outside world, Enron's profits could be whatever Enron said they were.
That fascinated me was that almost all of the Wall Street analysts who covered Enron had buy ratings or strong buy ratings on the company's stock.
Imagine, you see, what they said is quite interesting. Imagine you are signing a deal with a certain company, let's say for a 10 years period. And according to this deal, you will have profits of, let's say, millions and millions of rubles by the end of that period. Would you be showing that profit as already existing in your pocket today?
It is not legal.
No, it's not legal, but that's what they were doing. So every new deal that appeared was written down in their financial statements as already existing, as showing the profits that were only future profits, but at the same time non-existent. So this was one of the ways to show the profitability. So instead of showing how how they fare in business today. They were showing their future deals. But it could be that tomorrow or the day after tomorrow and next year, these deals could crash. As a result, the company would lose a lot. But the cash generated was already written in their statements.
Analyst who didn't buy the company line became an enemy of Enron. Enron's CFO, Andy Fastow, had his eye on John Olson, one of the only analysts skeptical of the Enron story.
Enron loved analysts' strong buy recommendations.
Merrill was informed by Fastow, either you get somebody who is on board with us and has a strong buy recommendation and loves us at the same time, or we don't do any business with you.
Merrill Lynch fired John Olson. Soon after, Fastow rewarded the bank with 2 investment banking jobs worth $50 million. His job was to cover up the fact that Enron was becoming a financial fantasy land.
So his job, well, this person whom you saw, Andrew Fastow right now, his job was to hide all sorts of unfair, unpleasant-looking facts in the activity of the company. You know what he did? He thought of an interesting thing of creating partnerships. And these partnerships were creating other companies who agreed to work as hedge funds. What is hedge? Hedge is zabor. Something that will close your potential loss in a different deal. For example, you are going to the bank to take a loan. And if, for example, it is not possible for you to return that loan, the bank uses hedge, using its contracts with an insurance company that is actually returning the potential loss that may happen because of your death or because you are not successful in life and so on and so forth. So you pay every year the insurance, and this insurance appears to be a sort of a hedge that closes your potential loss. So this person, Andrew Fastow, was thinking of the way to cover, to hide, to close the potential lack of success in the company by creating partnerships, who created other companies who agreed to cover every loss Enron was making. I'll be showing you the diagram later on for you to understand it better. So all good deals, all good incomes, all profits that were generated by this company was writing in the company's financial statements, but every loss was covered by another company. So it went to another company. All debts of the company went to some other companies, being present in a different statement. But the investors never saw it in their financial statements of the company.
To please the boss, Fastow had to figure out a way to keep the stock price up by hiding the fact that Enron was $30 billion in debt. Enron was just stashing its debt in Fastow's companies where investors couldn't see it. LJM was Fastow's most ambitious creation.
LGM is the company that was specially created to cover the Enron's losses, and LGM meant the names of his wife and 2 children, Leah, Jeffrey, and Mike. So these were the companies that were used to hide Enron's losses.
Worked magic for Enron, and it would allow Fastow to conjure $45 million for himself. Returns that would exceed 2,000%. 96 individual bankers invested in LJM, and America's major banks put up as much as $25 million each.
The Enron fraud is the story of synergistic corruption. There are supposed.
Do you know the word fraud? Fraud is a very important word. Yes, mошенничество. Fraud. F-R-A-U-D.
Supposed to be checks and balances in the system. The lawyers are supposed to say no. The accountants are supposed to say no. The bankers are supposed to say no, but no one who was supposed to say no said no. They all took their share of the money from the fraud and put it in their pockets.
It was easy to do, right? Everybody who worked in the company knew about this scheme. They knew about this scheme, but nobody said no. Why do you think it happened? Because everybody had a share in stocks of the company, and the stock was so profitable. So it was so good to be involved in this type of activity. Because when you are owning a share that is being traded in the market at a price of nearly $100 per share, well, it's so nice and so profitable. So everybody was actually was co-criminals in this activity. And this person was saying that none of these people who worked in this company, analysts, lawyers, business people, managers, nobody said anything to this type of activity. This was growing like avalanche, and it was leading to a complete crash.
Enron paid its advisors well. In 2001, the accounting firm Arthur Andersen received $1 million a week.
Can you imagine? Arthur Andersen, one of the leading audit companies in this world, one of the 5 leading companies in this world. Now, you know that there are 4 at the moment. PricewaterhouseCoopers, Ernst & Young, KPMG, and Deloitte. But at that time, there were 5. It was big 5. There was Arthur Andersen, but after Enron, it collapsed. Why? Because they received $1 million a week. That was a very good payment to consultants. And so as a result, they were also covering this crime.
Enron's law firm, Vinson & Elkins, did nearly as well.
Oh, for instance, one email I remember where the banker writes, Enron loves these deals. They produce cash, but they don't have to show the debt on the balance sheet. Now, a high school student can figure out that the banks were all knowing participants in this wrongdoing.
Merrill Lynch assisted Enron in cooking its books by pretending to...
How do you understand this? Merrill Lynch assisted Enron in cooking its books. Yes, cook books. It's a good expression, right? To cook books. Well, books meaning, well, bookkeeping, accounting. So to cook books means to do something wrong about the accounting.
To purchase an existing Enron asset when it was really engaged in a loan.
California was selected by Enron as the prime place to experiment with this new concept of deregulated electricity.
Commodity that normally trades in the $35 to $45 range, high prices are when it gets in the 50s or $1,000.
Prices aren't going to stay at $1,000 forever. It weeds out the weak people in the market. Get rid of them, and you know what? The people who are strong will stick around.
Traders soon discovered that by shutting down power plants, they could create artificial shortages that would push prices.
He said a very interesting thing. For example, Enron would be starting a power plant, investing in this power plant, writing down the potential, the possible incomes that this power plant may generate, and close it on the next day, after writing down in their statements the profits that it's expected to have within the period of activity of this asset. Creating a power plant, writing down in the statements the potential income that it may generate, and close it on the next day, but the statements would show that the income actually existed. That was very unfair. That was unethical. That was fraud. The investors were simply misled by this type of activity.
Get a little creative,
okay,
and come up with a reason to go down.
Like a forced outage type thing.
Right.
West Coast traders made nearly $2 billion for Enron.
The differences between the state of California and the Titanic. At least when the Titanic went down, the lights were on.
In 2001.
The value of Enron at its highest point was over $311 billion US. That was huge, but none of the investors was conscious of the fact that there was over 30 or 35 billion US dollars as their debt. It was not shown. Can you imagine the debt of such great amount, so about 35 million US dollars was simply hidden, was not in their statements.
2001, less than 4 months after Skilling's resignation, Enron declared bankruptcy. Its accounting firm, Arthur Andersen, had begun destroying its Enron files. Enron's accounting firm, Arthur Andersen, was convicted of obstructing justice. With its
Obstruct justice? How do you understand this phrase? Right.
With its reputation for honesty destroyed, America's oldest accounting firm fell along with Enron, and 29,000 people lost their jobs.
Isn't it a tragedy that within just overnight, 29,000 people lost their jobs, just overnight, when it all became clear that the company was doing unfairly? Well, naturally, after this situation, the U.S. authorities started thinking about introducing a better regulation into the business activity. How to regulate the business activity? What sort of outcome or conclusion you would make in order to make and regulate business in a country in a better way? What sort of thing, well, what this experience could show? What sort of steps should be made in order to avoid such things happening again and again? Your ideas about what you would be doing. Imagine you are the investors of a big company, for example, and you have shares in the big company, but you don't know what is happening in this company. The management of the company may be doing lots of things without telling you, hiding debt, showing great profits, well, so having deals and then destroying these deals, writing unfair figures on their statements. What would you be doing? What do you think would be the solution for this situation? Actually, what happened in the United States of America at that time changed the face of the whole business in the 21st century. A single act, the Sarbanes-Oxley Act that was passed in the year 2002, introduced new rules for the relationship between shareholders and businesses. And the key word for what they were doing was transparency. Transparency is something that is a must for the modern business. And transparency should be shown at every possible step of your activity. You should have cameras installed everywhere. You should have reporting and audits, independent valuation, independent reporting, all sorts of activities that are engaged and that are being supported by the company management to show that they are transparent in all their dealings. So Sarbanes-Oxley Act is based on the names of two senators of the United States of America who actually suggested that such a law should be introduced in the United States of America, and those who do not obey this law could find themselves in jail or should pay huge fines. So just a brief video to give you a general idea of the Sarbanes-Oxley Act that is very, very important today still, and in this country acting as a concept still in this country too. Every business in this world is interested in giving the idea of having transparency.
Let's take a deeper look at what the Sarbanes-Oxley Act includes. First, officers of the company are required to sign financial statements for accuracy. This holds them personally accountable for any misrepresented data.
Formerly, it was done differently. You just invite an auditor, he signs your financial statements, and that's that. The company that was the auditor who was signing your contracts was sort of in charge of the fairness, of the trustworthiness of the figures that you were showing. Now it is the officers of the company themselves need to sign this document, proving that what is written in the financial statements and all the comments that are being made are fair and true.
Second, an increased fine and/or prison sentence was set for individuals who attempt to defraud investors or misrepresent actual figures. Third, the company must provide a description of its internal controls. This is an attempt to increase the confidence of the public in that organization, while allowing them to gain an insight into the company's procedures. Fourth, the company is responsible for hiring an independent accounting firm to come in and audit the accuracy of their financial reports. The financial reports are now required to have a section dedicated to the auditor's opinion as to the accuracy of the figures presented in the reports. Fifth, the company is now mandated to report all off-balance sheet transactions on their reports.
All off-balance sheet transactions must be reported. This is quite interesting. Imagine, for example, you have a company and you wanted to start some sort of business that you don't want to show to your investors. For example, you think of you are producing, let's say, bottles for just to be sold to the milk industry, to the industry that is manufacturing, that is producing dairy products. But then you said, well, why not starting, for example, an alcoholic drinks factory somewhere? And then you set up a factory somewhere, and you start using cash from this company to set up deals with this company. So all subsidiaries, all affiliations that are in the company should now become part of a single report. this is a new standard of reporting. We are going to spend just one lecture devoted to different types of reporting that exist today. So today, it doesn't matter how many subsidiaries or affiliations you might have around the company. Everything should be on a single paper, on a single report showing what is happening in this company today in order to increase transparency. Because very often, for example, a big company like a blue chip, like a big oil and mining company, resource company that is having a lot of subsidiaries, will not be putting their activity and their financial results of its subsidiaries on its main accounts, and therefore it would be unclear for you whether the company is doing well or is not doing well, because it might have 100 subsidiaries here and there. So the company may be showing itself quite well, but at the same time financing the activity of its subsidiaries that may be creating loss, that may be generating loss. So these things are very important to be shown on a single balance sheet.
The headline question when considering the ideal regulatory structure is how to strike the right balance between two principles: market discipline and market oversight.
That's Bush administration Treasury Secretary Henry Paulson speaking last September, just 10 months ago. And here's President Obama pretty much saying the same thing.
What we've proposed is to essentially update those regulatory tools that existed back in the 1930s that were put in place after the Great Depression to increase transparency and openness. But I think everybody would acknowledge that if we've got rules of the road, that's what makes American capitalism thrive.
Under the plan, which administration officials refer to as a white paper, new powers for the central bank, the Federal Reserve, to oversee the biggest players, firms whose collapse would rock the whole economy, as with Lehman Brothers. New rules for authorities to unwind and break up important companies that are going wrong, as the FDIC agency already does with the banks. And a new Council of Regulators with broad, coordinated powers to make sure that consumer investments are safer in the future.
Finally, the Securities and Exchange Commission is given more power to look into companies that are...
Securities and Exchange Commission is another important word or phrase. It's the chief regulator of the financial markets in the United States of America. The chief regulator. What is the regulator? Regulator is setting the rules for the activity of every company that wants to sell its shares on the stock exchange, creating rules. Who is the main regulator in our market in Russia? Central Bank, right? But formerly we had two. We had Securities and Exchange Commission that was working in this country, and the central bank has recently been chosen as a single most powerful regulator of the financial market.
Companies that are suspected of wrongdoing. The SEC will now do random reviews of companies to ensure that they are complying with the Sarbanes-Oxley Act.
The key word here in this part is compliance. How do you understand the word compliance? Compliance. Comply and compliance is a very important business word. Compliance means correspondence with the main standards, with the main rules and regulations that are set either by the company themselves, its management, or the main regulator. So compliance is something that business is talking about all the time. Compliance with its strategy, compliance with its marketing policy, compliance with the rules set by the main regulator. So it's one of the buzzwords actually in the business today.
The reports are then published and released to the public for viewing. The SEC has a special division that is designated to work with Sarbanes-Oxley issues. This division is called the Public Company Accounting Oversight Board.
So all companies, all public companies and publicly traded companies should be compliant. The activity should be compliant with the Sarbanes-Oxley Act. What is a publicly traded company? How do you understand that? On the stock exchange. Not all companies have this stock being traded on the stock exchange. Not all of them. And the companies who decide to go to the open market and start trading go through this procedure that is called IPO. IPO, initial public offering.
Take it.
All right. So the company that is not compliant with the new regulations that makes this company transparent to the investors, its operations clear and obvious to the investors and shareholders, may be subject to all sorts of fines, penalties, and also in its top management can be imprisoned for not complying with this. Do you know what the companies are doing today to show that they are transparent? They are doing well. What sort of activity is going on in modern business in order to give the investors the feeling that everything is doing well, that everything is so well with their business? Publish. So quarterly reports, annual reports, investor days, websites and different types of websites that is possible. The investor relations page on their website, also an absolute quite a new type of transparency that is being created today, is showing that business is socially responsible. How do you understand social responsibility of the business? Social responsibility is, for example, you are an oil mining or gas mining company. How do you show your social responsibility to your investors? Yes, you create a different report, ecological report, just stating how much amount of money you actually spend in supporting the ecological activities. So the companies start today publishing lots of different reports: social reports, ecological report, non-financial report, financial report, different papers every year. And actually, this is quite a big amount of money that the company is spending every year in order to support transparency. And there are hundreds of people working on that. And this is a very good market today. You'll find here a lot of companies working in today's market who are involved in preparing annual reports and creating the designs of annual reports, creating presentations. A lot of people who are writing, the journalists who are working for the publication of at least 100 articles about a big company in press every month. So this is quite a big activity. But all of it is actually all of it circles around the necessity to give the investor the impression that the business is doing fairly, that the business is fair, and so nothing that could be detrimental to their business is hidden. All right, so I was giving you this example, to show that sometimes in the analysis of business, very often many things that are being said to you may look only nice at the outside, as a windshield, but at the same time, many things would be hidden behind. Therefore, you as potential investor or a shareholder, you should learn to read one of the key documents of this company, the financial reporting, financial statements, in order to understand how the company is actually doing, and are they doing well or not. So this sort of general vision of how the company acts, fares, is called the fundamental analysis. Fundamental analysis. It's like when you are looking at some person and you're thinking about employing or not employing person, you will be taking into account some very important facts from his or her life, thinking about what he can do, what he can't do, whether the person is lying or not lying, whether he's telling you the truth, whether he or she can possibly act in a particular way. So this activity of singling out the most important, the most fundamental parameters of the business and putting them all together in your mind as the necessary, indispensable basis for the activity of this business is called fundamental analysis. There is a small video that is showing the main essence of fundamental analysis, as I said to you, but this is just a summary of what I said.
Fundamental analysis is the process of examining a company's financial statements to decide if its stock is a good investment. Financial statements include balance sheets, income statements, and cash flow statements.
So we spoke about balance sheet, but two other statements we're going to analyze today.
This information helps determine the financial makeup of the company behind the stock. In this video, we'll explain how fundamental analysis uses these statements to help evaluate a company. Let's start with the balance sheet. This document compares the company's current assets to its liabilities and owner's equity. Let's define these terms. First, we have assets, which are items the company owns and have the potential to provide future value. Assets are usually comprised of cash, equipment, and property. Next are liabilities. Liabilities are usually debts or accounts that need to be paid. Often a liability on the balance sheet has an offsetting asset that helps the number stay level. For example, if a company were to take a loan out to buy a property, the loan would be a liability and the property would be an asset.
So offsetting principle, how do you understand this word? Offsetting principle. Offset, how do you understand the word offset? Balance. So offsetting principle means that if there is something on one side of the scales, there should always be something on the other side of the scales. So there is an offsetting principle.
The third term of a balance sheet is capital or owner's equity, which is the amount of assets raised by issuing stock. For example, when a company issues stock either in its initial public offering or in a secondary offering, it raises money or capital that can be used to fund various business expenses. Balance is achieved when the value of the assets are equal to liabilities and owner's equity. The balance sheet helps you see how a company raises money for its assets and can help you determine if the company is overextended.
How do you understand this? How the company raises money for its assets? How the company raises money? Financing, and there can be, just repeating very quickly, financing, there can be just several ways of doing that. By debts, loans, debts, or attracting financing from a possible investor in order to buy new assets and then start new business.
However, if you want to know how the company earns money, you'd look at its income statement. An income statement shows a company's revenues and expenses. These are the costs associated with running the business.
This is something that we are going to analyze and speak in greater detail today. Maybe I'll stop showing my video at this point and I'll start asking questions. Imagine you start doing your business and then you want to see how profitable you are. You want to commit it all to writing and see how your business is doing. Is it doing well or is it not doing well? What sort of paper you would be creating for yourself? What sort of actually inscriptions or notes you'll be leaving in this paper in order to show yourself, in order to understand whether you're doing well or whether you're not doing well. I think you have your home budget, and when doing your home budget, what do you write in your notes? P&L. Yes, P&L was profit and loss. So the income statement is just the description of how much money you earn and how much money you lose. Imagine. Okay, let us take a very ordinary business of manufacturing tables, of producing tables. What sort of things you think is necessary to write for you in order to understand how successful your business is? What sort of inscription or note you will be writing at the top of this long table? Yes. What is revenue? Or revenue or sales? What is that?
Money you get from selling your item.
Right, selling your item. So you sell all the tables, for example, at a price of $1,000, and then you write that you received $1,000. What would be next? What else should you be writing or adding to this table in order to see how profitable you are? To count all expenses. Would you be doing it in a systematic, hierarchical way, or would you be choosing some sort of a principle to write all your expenses in order to see what is happening there at the bottom line? Because at the top line there are revenues, right? But at the bottom line there would be the net income that you receive, the free cash flow that you receive. So how would you originally or possibly think of arranging possible costs, possible expenses that you might undergo in the course of the manufacturing your tables.
Just the cost of goods sold.
Cost of goods sold, which will include cost of goods sold. Cost of goods sold, or COGS. So it will. The Russian for that is. The Russian for that is. Себестоимость. Right. It may include what? It may include raw materials, materials that is necessary for your product. What else? Transportations, right? Transportation expenses. What are the expenses you might be undergoing? Packaging, right? What else? Taxes. Do you think you need to include taxes here? Probably no. Probably too early. Too early. Because first you want to see how your business fares. Is your business successful? Is your business as business successful at all? But taxes does not belong to your business. Taxes belongs to the state rather. Therefore, you cannot influence taxation at all. But you can influence how your business fares. All right. You may include the cost of materials, the cost of packaging, the transportation. What else? Advertising, yes, possibly. What else? Think of something that is necessary for the operations. Administrative expenses, meaning paying your director, paying your accountant, paying the people who are right to employees. So wages and salaries. Wages and salaries could also be included here. All right, and then probably at this stage you would like to draw another line and see how successful your business is. Meaning after you paid for the materials, after you paid for the transportation, you paid for the administrative expenses, you decide to draw a line probably and see whether you are good at this stage or not. What you will be doing at this stage? You will be subtracting all these expenses from the revenue, and you will get the first thing that will be called the operating profit. The operating profit. Or you will have the gross profit. Or валовая прибыль, gross profit. Then you will probably this will not be the end of all your efforts. What else? What else could be included in the whole business activity of your enterprise? Depreciation probably will be much lower, right? Much lower. But before that, there will be a certain activity that is still related to the manufacturing of your tables.
Operating expenses such as payment for management.
We paid already at the top. There is something else that we need to take into account. Don't you think it is necessary for you? Interest and income tax. I think it is later, because higher still there is something else that you should do in order to create to have a better vision of how business itself fares. I think transaction costs maybe, but I think at this stage it is also important to have somebody who will be doing research and development activity in the company, who will be investigating whether this type of tables is acceptable in this market or not acceptable in this market, developing new types of tables, developing new models that may be interesting or acceptable for different people in this market. So it's actually the necessary part of the success of your business, right, as it goes. Because without this development, you might be producing something that nobody needs in this market. And then, well, what happens if the company is producing old-fashioned tables that nobody is buying? So, and only then you will start subtracting from this. You draw another line. You have another type of profit, and then you start subtracting such thing as taxation, interest, depreciation, in order to understand what the net income is. So this long table, this long subtraction table, it's called income statement or profit and loss statement. It is necessary for you to understand how business actually fares. What sort of profit it generates through its activity when it is thus logically and organizationally structured, so well structured. So let us continue having a look at this video summary.
including operations, interest paid on loans, and taxes. When you take revenues and subtract expenses, you get net income. Net income is the earnings of a company. Earnings are usually handled in two ways.
So we have at least two different types of income that is the profit that is important. So we have gross profit. Gross profit is valoarea прибыль, and we have also net income. Net income чистая прибыль that is received at the end of the bottom line, of all these calculations.
The first way is to share the earnings with shareholders by paying a dividend.
So, as we know, not all companies are paying dividends, and many companies instead prefer to do something else.
The second way is to reinvest these earnings into the company. Reinvesting earnings can help a company's cash position. A company with a good cash position is usually better prepared to endure economic ups and downs. This is what.
How do you understand this phrase, cash position?
The amount of cash you possess.
The amount of cash you have today in the company. As we say in business, one of the most important principles is cash is king. Cash is king. If you have cash actually in the company today, you can actually cope with all sorts of difficulties very easily. How can it be that, for example, you can be quite successful in building your operations, but at the same time not having enough cash in the company? How is that possible? How may this situation may appear?
Reinvesting too much.
Investing too much. Reinvesting too much, meaning spending too much of your net income, not having anything on your bank account. What else can there be? What other difficulties can there be in having enough cash today? Money laundering. No, there could be quite regular, standard types of difficulties that may prevent you from having cash today in the company. Thus, for example, you sell a product to somebody, and this somebody doesn't pay you. So what is happening in that case? When somebody does not pay you, at the end of the month, for example, this is quite normal. You would ask a company, your client, your partner, to pay you according to the contract, and the company, or your client or partner, doesn't pay you. What happens? You have no money. You have no money to pay your salaries, to pay wages, to pay interest on your bank accounts. You may suddenly, your business may suddenly actually be disbalanced, and this crunch may appear as a very difficult problem for you. There are two types of indebtedness, meaning money that you either have to pay to somebody, or money that you need to receive. The money that you need to receive from somebody as payment for your service or your products is called in Russian debitorskая задолженность. Debitorskая задолженность. What is the English for that? Receivable. Not only that, yes, account receivables. And yes, and the money that you have to pay, that you are obliged to pay to somebody, that you are indebted to pay, is called account payable. So account payable, account receivable. So this account receivable could be one of the difficulties of not having the money today, and as a result you may have the crunch in the company, not having cash necessary to pay for your current operations.
This is why investors say cash is king. It's also why the cash flow statement is so important. The statement shows how the company uses its cash to operate the business and make investments. It also shows how much is borrowed from a bank or bondholder. These figures are totaled to show changes in the company's overall cash position.
How much money do you need every day in order to survive? Do you ask your parents to supply you with a certain amount of cash every month, or do you earn this amount of money yourselves? It's a secret. But it may be that you may be. What do you think is a good salary for you, if you started working today? What amount of money you would want to have by the end of the month as your revenue? 50,000 rubles or 100,000 rubles or anything? Would you want to have it all this money today, or do you think you will agree to have this money paid to you little by little, step by step? depending on your needs. What is your preference? To have it all overnight?
All today.
All today. What for?
No, step by step.
Step by step. So there are different. Business also acts very much like this. You think as Enron. You want to have everything written down today and everything, all your money in the pocket today. Why? Because you think you can be quite rationally spend this money.
For me, I can buy something big.
And start something big, a sort of an asset that will start generate cash for you by the end of this month. And in that case, you're not spending money. This is not an expense for you, but this becomes a capitalization. This becomes a capitalization. So in your case, the money that will be given to you, it may be an operating expense, OPEX, operating expense. But in your case, if you think that you want to have all money today, now, because you hope that you will buy something useful, some sort of an asset that will start generating additional cash for you today, it is called CAPEX, capital expenditures. So there will be different approaches in spending money. And depending on how successful you are, either here or in the first case or in the second case, you would be either successful or not successful, having cash at your disposal always during the month, or maybe there would be certain crunches that will prevent you from operating successfully.
This statement is important because it gives a more detailed account of how the business generates revenue and is therefore much more difficult to manipulate than an income statement. As you can see, there is a lot of information in the three financial statements.
Do you think, if you look at the financial statements as they are, as I explained to you now, do you think it is enough for you to give a certain vision of how business operates, whether it is successful or not successful? Do you think when you come to a company and say, give me your financial statements, and you have a look at them, you will have a look at the balance sheet, you will have a look at the income statement or a cash flow statement, do you think this is enough for you to have a general vision of how the company fares? Or do you think you will need any other, some sort of additional information, or these tables would be enough? Any ideas?
Where is not management efficiency?
So you want to know you want to get some information about the management efficiency, and this you will receive by creating all sorts of ratios. You will start dividing. You will start building the relationship between different parts of the financial statements. Yes. Footnotes. Yes. You want an explanation for certain things. This is called management discussion and analysis that is normally included in the annual reports of the companies, where the management normally accounts for every step they're making, accounts for every item that is on their balance sheet. Good words, every item, not every line, but every item on the balance sheet or the income statement, explaining what is happening. And you as an investor, as a potential investor or a shareholder, you will be creating all sorts of ratios that will give you an idea of how the company operates, whether it fares successfully or not.
With all of these facts and figures, analysis can be a little tricky. This is why investors may use ratios. There are several ratios that can help an investor compare stocks, but we'll focus on one of the most common, the price to earnings, or PE ratio. Let's say you have one stock that costs $6 a share, another at $35 a share, and a third at $132 a share. How would you know which one is the best value? You might assume the $6 stock is the best value because it's the cheapest. However, this might not be the case, because a company's value may depend largely on the company's earnings. The PE ratio allows you to look beyond the price of a stock to see which company could be the best value. To create this ratio, first divide the net income or earnings by the number of outstanding shares. This number is called
outstanding shares. How do you understand this term? Outstanding shares.
Shares that are in exchange.
Yes, shares that are in exchange, that are being sold today. Yes, in the stock exchange. That's true.
This number is called earnings per share, or EPS. Next, divide the price of the stock by the EPS to get the PE ratio. The first company is trading at $6 and has an EPS of 20 cents, resulting in a PE of 30. The second company is trading at $35 a share and has an EPS of $1.40 for a PE of 25. The final company is trading at $132 per share and has an EPS of $3.90 for a PE of 34. Now you can better compare each company by its PE ratio. Despite the drastic difference in stock prices, all three companies have a similar valuation.
See, so the actual price of the share doesn't mean anything. The share, actually, the stock may have a different price in this market, but PE ratio will give you a better idea of how the company fares.
However, the second company has the lowest PE ratio and may be the best value. Remember, a PE ratio is only one of several ratios that can be used. There are other ratios for determining valuation, profitability, and financial strength.
I will give you a special task in Basecamp explaining different ratios. So you will have to write the definitions for different ratios. You will see how you understand this stuff. Now, I want now to have a very quick review of the income statement that we so briefly had a look on. And the next video that I'm presenting to you gives an idea of different items that are on the income statement and how they should be interpreted. So let us see how it goes.
These numbers are there to help you understand which items we are using in our calculations and how to do the calculations that end up giving us insights into the income statement.
So this is a typical income statement, and it shows you what I have already explained to you. I will publish this presentation on Basecamp, so you'll have an opportunity to have a look at this once again. But you see at the top there is an item called sales, which in your terminology was revenues. That's true, right? And then comes cost of goods sold. You mentioned this. This is себестоимость, or something, the amount of money that you spend in order to manufacture a certain item or to deliver a certain service. At the end of that, you will get the gross profit.
Since the income statement is a measure of profitability, the first thing we want to do is analyze some of the profitability measures. The first one is gross profit, which is the profit the company made on sales after cost of goods sold. We are going to calculate the gross margin to look at profitability as a percentage.
Gross margin, how do you understand that? Yes, that's true, right? But it is margin, right? It's margin. It's margin. So it doesn't show you the absolute figures. It shows you the ratio again. It shows you the ratio, which is a very important parameter for the investor shareholder.
The gross margin is calculated by dividing the gross profit of $1,987,000 by revenue of $11,892,000, and we see that the gross margin percent is 16.7%.
Is it good or bad? When you receive this figure, this calculation, how do you understand whether it is good or bad? What sort of information it will give you when you divide the gross profits by sales? Why is it so important? Why is it so important to know this figure? From your point of view, what is so significant in this figure? Why we need to stop at this stage and create this calculation?
It's percentage that we should compare with the opportunity cost of capital. If it's more, then it's good.
So it will show you in general how successful a businessman you are, actually. If you can, for example, manufacture tables, and you spend a lot of money buying raw materials or paying to your stuff and so on and so forth, and then sell your tables at a very cheap price, then probably you are not a very successful businessman. So this ratio will simply show in general how efficient you are not even as a businessman, but as a manufacturer. Is the business at all feasible when you are doing this? It may be that you say, I will start manufacturing tables made of a special material that is brought from Africa, for example, the special type of wood or timber that grows there, and say I will start selling it in the Russian market, for example. Would you be believing this businessman, or would you start asking questions about the feasibility of this business? Probably you will, because this person probably will not take into account such expenses as transportation or customs and so on and so forth. As a result, this gross margin will be very, very poor, and as a result, you will understand that this business cannot be successful. Okay, what next?
Now, whether 16.7% is good or bad is something we can't tell just yet. We'll discuss how to determine if this is good or bad in a moment, but first we'll define a few other profitability ratios. The second profitability measure to analyze on the income statement is operating profit. We calculate the operating margin by dividing operating profit of $752,000 by total sales of $11,892,000, and that shows that the operating margin was 6.3%.
Why do you need this? From your point of view, why is this figure important? See what the operating profit includes. So it says research and development, it says selling expenses, it says general and administrative expenses, as you mentioned, and then total operating expenses. What sort of information it can provide for you when you have a look at this type of ratio?
How effective the manager you are.
Yes, that's true. How effective the manager, and whether you understand your market in general, whether you understand what should be done in order to make your product that you manufacture successful in this market. So, as different from the first one, the second one will give you a better idea of management. Okay, what happens next?
The next profitability measure is pre-tax income. To calculate the pre-tax income margin, we divide pre-tax income of $881,000 by sales of $11,892,000, and we end up with a pre-tax margin of 7.4%.
What sort of information does it give you at this level? Does it give you any information about the feasibility of business and about the talents of the management, or any ideas about what sort of valuable knowledge you will gain from looking at this figure? It's close. But this is basically a small thing, right? It's just interest that you receive on the deposit that you have in the bank. So because this is a plus, this is not a minus. So actually, this is just a small addition to what is there on your income statement. Just a small addition. Have a look at the figures. The operating profit was 752, but the pre-tax expense is 881. So this is just a small amount. This just shows how fairly and successfully you deal with the banks. Deal with the banks and with the deposits in the banks.
The final margin that we can calculate on this income statement is the net income margin. We divide net income of $397,000 by total sales of $11,892,000, and we have a profitability margin of 3.3%.
Is it good or bad? 3.3%, the profitability margin. Depends. Yes, depends. It depends. Yes, depends on the industry. That's right. Therefore, when, for example, when you look at some business and they say that the profitability margin is 25%, for example, you say, "Ooh, it's huge." But in some cases, for example, the insurance business will be telling you that their profitability margin is about 2%. Then you will say, "Well, this is it's unclear what is the total revenue they get." And so in order to get the general information how good or bad it is, you need to have a greater picture of all the cash that actually goes through, that the business is generating on a regular basis. So when looking at the income statements at different levels, you have different types of information. But generally speaking, it is something that I call вычитание столбиком. Вычитание столбиком. You just subtract little by little from the previous item a certain amount, and then it is you see what is left at the end. This figure, the profitability, the net income margin, it doesn't include something that is quite significant. Any idea? We live in the state. And the state also has a certain actually demand on you. The state also would require that you would also pay something to, yes?
What about taxation?
Taxation? Exactly. So right.
The word tax
Yes. There will be taxation, there will be interest, there will be all sorts of things that are not dependent on you. You do not decide that. Meaning you do your business, but it may be that the taxes are so high and the interest in the banks are so high that all your profit that you have been generated so far will simply be lost on paying all this. Therefore, one very important parameter at this stage is something that is called EBIT or EBITDA.
This 3.3% profit margin means that for every $1,000 of sales, the company generates a profit of $33. There are a couple of other very common income statement calculations. One is called EBIT, EBIT, and the other is called EBITDA, or EBITDA.
The Russian translation for this is EBITDA. It's interesting. Nobody is actually translating it. So EBITDA means earnings before interest, taxation, depreciation, and amortization. So EBITDA.
EBIT stands for earnings before interest and taxes, which essentially is operating profit. EBIT.
Operating profit. You see, it is line number 8. So EBIT is line number 8.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. We will discuss these items in greater detail in our intermediate financial statement analysis, but we just wanted to include the definitions and calculations here for your reference. So here is a quick summary of the ratios we calculated. The gross margin is 16.7%. After taking into account operating expenses, the operating margin is 6.3%. The pre-tax margin increases to 7.4% as a result of having some non-operating income. The net income margin drops by more than half to 3.3% as a result of taxes and extraordinary items.
So this is a very quick summary of what the income statement is, and I hope that by doing your homework that I will send on Basecamp, you will have a better vision of this. When I ask you, by the way, to develop a certain presentation, a PowerPoint presentation in Basecamp, my expectation is that you do not just provide a summary of this by picking up certain words and phrases from the document that I publish, but you present to me the general understanding of that and expressing it in English. Therefore, when you are preparing your presentations, try to make it more or less creative and not just repetitive of what is being said in the document. I hope this is perfectly understandable. So, in the remaining 7 or 10 minutes, we have very quick overview of what the cash flow statement is. The cash flow statement describes to you the situation where you need to know how much money you actually have in your pockets today. How much money do you have in your pockets today? Are you poor or are you rich? Let's assume that those who have over $5,000 in their pockets are rich. Raise up your hands, those who are rich. So we do not have rich people. But probably, well, in our pockets, well, actually I have none. I do not have any money at the moment. So, and I'm very poor. But if I need to pay for my flat, if I need to pay for the education of my kids, and so on and so forth, I need to have a very definite vision of where my money is and where they appear. So this small video will give a summary of how you create cash in your business. So once again, what was that statement that I was giving you about cash, and that was repeated? Cash is king. Cash is king. This is one of the most recurrent statements in the modern business.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's Carpets. For Ed, cash flow is essential to the survival of his business, as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally three types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch.
How do you understand a cash flow crunch? How do you understand this notion, cash flow crunch? In Russian we say sometimes, we use sometimes the term кассовый разрыв. Кассовый разрыв. It may be that you will have enough money in general on your bank account, but you are unable to pay, for example, your employees, or you to pay for certain services that are rendered to your business. Because of what? What do you think could be one of the dangers for the business if, for example, the business is being operated by by the owner of the company? What may happen if the business is operated by the owner of the company? The owner of the company may come to the cashier and say, I need $10,000 today. Just I need it badly. He may come and if he or she takes $10,000 from the cashier of the company, kassir, what may happen?
He may spend it on himself.
Yes, and as a result, but this should be reflected in the cash flow statement. This should be reflected as a cash flow statement. How would you reflect it in a cash flow statement? So there are three types of expenses, right? Or three types of items that in a cash flow statement. There are operating expenses, investment, and debt. How would you write if you were the accountant? How would you write? For example, the owner comes to you and says, "Please give me $10,000." I see you have one. You have just this amount in the cash desk of the company. Well, what would you say to the owner? Yes.
No, sorry, I can't, because we will get problems with our debt, or we will get problems with institutions or
Investments. So there are provisions. There are sorts of provisions, and this money that you have in the cash desk of the company may be simply allocated for some sort of activity, and you cannot simply possibly just take this money in spite of the money's availability, and you can't give it to the owner, right?
You can say that it is a capital.
It is a capital, right? But if your owner insists that he or she needs this money, what would you do? You will give this money just to the boss, and is that all? What would you do? If I were the accountant, yes. Write it as a debt, or for example, I worked as an accountant once for No, I write it just as advance to the boss. Advance to the boss. So this is a good statement. Advance to the boss. And I remember when once when I was working as an accountant also for the newspaper bureau here in Moscow, and they decided one day to make a very good present to one of the clients. And I said, Andrew, what shall we write? Because this was quite an expensive present. What shall we write in our accounts? Because I had to write it somehow. We couldn't just simply take this money and spend this money. We had to write something. So when you buy a present to somebody, how would you write it in your statements in order to reflect it, to represent it, to represent it adequately, so that it would make sense?
public relations expenses.
Public relations expense possibly could be, but I was told to use the word gratuity. How do you know the word? How do you understand the word gratuity? Gratuity means подарок, or expression of gratitude to somebody. So, and you can be very, very creative, and sometimes you can be very creative in conducting your cash flow statement. But it's important that not a single pence, not a single kopeck, is actually should go from the cash desk without being actually represented in your cash flow statement. And I'm using the right word for this case, and you should take into account. So there is also the representation of a certain activity on a cash flow statement.
To avoid insolvency, Ed will have to arrange some type of financing or bridge loan.
What is insolvency? Да, банкротство.
A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
Thank you. That is all for today. We discussed income statement, transparency, cash flow statement, and the rest of the reading and the tasks will be in Basecamp. Do you have any questions? No? Thank you so much. Thank you. Thank you.